Okay, good afternoon, everybody. Today is Friday, the 24th. This is the weekly take on the market. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Here's the disclaimer: not licensed, no buy, sell, hold recommendations. Please take a moment to read this. Okay, and the drill: market thoughts, industry groups, stocks to watch. This will be my second go round with this video. I just realized as I was about 2/3 of the way through the video that I forgot to continue the share of my screen. So I have some practice on this one. We'll see if that makes a difference on the video. So market thoughts. Somebody sent me an email about the seasonality that I mentioned last week. And I was unaware, it was kind of new to me. I didn't realize there was that kind of short-term seasonality weakness historically. Here's another screenshot of that. So we've had some of that weakness. I think the market topped short-term this year. The high is a couple of weeks ago. But the good news, if it follows this path, is, we're halfway home. Somewhere in March, the market will turn and you get a really nice, strong seasonality period. Then you get into May, which is the old sell in May and go away. Sell in May and go away, but I guess when are you supposed to come back? Maybe January 1 is based on that kind of saying. But so you get a little weakness in May, a little bit in June, then a nice period with the market. And then you have September, October. And most people think of October as the worst month, but really it's September. I think September is the only month historically with negative returns if you only invested in the month of September, if I remember correctly. Every other month historically has positive returns. And then you get the last quarter, which is the sweet spot for the market and for our style. And, I told you last week, I think William O'Neill and company, studied seasonality based on their money management in-house, and fourth quarter was the strongest by far. So we're in a little bit of weakness in the markets. It's okay. It's fine. There's nothing terrible about it. Let's pull up the market. And I am not going to forget to resume the share this time. So here's the NASDAQ. So there's the high this year is on February 2nd. You got a little bit of pullback. It's right on those moving averages. One guy I listened to on podcasts, Carter Worth, I don't know who he's with anymore. He used to be with Oppenheimer, but he always, if they ask him about a stock that he thinks it's just pedestrian, he would say it's a pair of twos, a poker analogy. So I like that. I think that makes sense. A pair of twos is just an okay hand in poker. It is a pair, at least you have a pair, but it's the worst pair possible. So that's to me what the market is right here. It's a pair of twos. It's not terrible. It's not bad. It's not great. It's not good. I hem and haw about the overall indexes. They have fooled me enough that mostly it's low on the totem pole in my decision making. But I don't want to give up on it completely. It is the M and Can Slim. But for whatever reason, I just think the markets have gotten a lot tougher, the overall markets, in the last dozen years or so. So I've strayed away from the overall market mostly. I like to look at the stocks, the leaders, my portfolio. Am I making progress? In this period here, I've had some stocks, and I'll show you some of the shipping stocks go nothing but up. So if I was like worried about the market, worried about the seasonality, sold all those stocks, watch them go up, that'd be really frustrating to me. So it's in reverse. They were acting good. They looked good. No way I'm going to sell them. Now, maybe I might put on a little bit more short to offset the market. And I'll talk a little bit about that as well, but it might not be for everybody, but that I might do that, and I'll have a little segment. We'll talk about short sale. I'll pull up Tesla in stocks to watch, and I'm giving myself some notes here. So I don't know. I don't hate the market. I don't love it. I think it's just okay. If it did this, it wouldn't shock me if it did that. And I'm not saying in one day, I'm saying over a number of weeks. That wouldn't shock me either. I really like, my gut instinct tells me that, so here's the bad break from the 2000s top. Now, we didn't go down this much on the indexes, but the indexes did a really good job of masking what happened last year, last 16, 18 months. I mean, everything got torched. Twilio, Shopify, C Limited. I don't even look at C Limited anymore. This is my favorite stock here. I'm just enamored with it. It was the best one for me in that time period. I've totally forgot about it. So, went from 300 down to 40. So this is a nasty bear market. So it did, the indexes, for whatever reason, I guess we could debate that a million times, but they just held up much better. But once the bear market was over, you see how the bars are much smaller. This is the monthly bars. And I've talked about that before. I want the market to pull out the volatility. If the volatility has been sucked out, then I can take bigger positions because I can manage. I know what my risk is. If I need to get out, whereas when there's lots of big bars, it makes it harder to know what your risk is as far as volatility. Now, some people will say volatility is not risk. I was reading about Michael Burry, he doesn't, and I understand that process, but back to one of my quotes, I have to manage the market within my own kind of emotional framework. And I know what I will do if there's a lot of volatility. I will mismanage it. So you get this little uptrend and then back down. So this is a monthly chart, so it doesn't look like a lot, but that is what, 20%. And then the market goes up, then it corrects, it goes up, it corrects, it goes up. And then, you get the great financial crisis. But in this period was a really great period. And that's 02-ish, 03 to 07-ish, 08, 4-year window. That's more than enough time to make really good money in leading stocks. So maybe the market does this. It's kind of what I think. So if we go to the current market, let's go to weekly. And I just think we're just going to be in this really large range for a number of years. Maybe it's upward bias because the market tends to have an upward bias, something like that. But you can see, like, look at these bars. It just, look how small these weekly bars are here. And the weekly bars in here, they're pretty large. So hopefully they'll contract. Look at this. This was like a sweet spot for our style. I remember at O'Neill, there was some of the managers, and it was just a great time. You could really be heavy. You could be leveraged. You could use margin because you weren't going to wake up and have the market down 10%. It was highly unlikely. You could manage your risk. Look at those. That would be sweet to have something like that again. Did we look at the S&P? I think we did. Very much the same. Other areas, China looks tired at best. Emerging markets doing what they do. Right when they look good, they go bad. Not all that exciting. DTH is okay. Like if I had to own an ETF, I think this is probably one you could own, but I don't own it anymore. It's okay though. So it all comes back to a pair of twos. The market's just okay. I think IBD has a market under pressure, and I see the Slack channel. We talk about exposure and things like that, and I think they've got their exposure maybe 40 to 60. It's kind of a guide. The uptrend under pressure, market and correction, confirmed uptrend. We need more tools in our toolbox, and we are working on adding different things like that. because it's not so black and white all the time. But read the big picture. Don't just read where it says upturn under pressure. Okay, what is that? But in the big picture, they'll tell you kind of the thought process in the background, as far as like if you're looking for a guide as far as exposure. It's just a guide, but it's just something to think about. All right. Resume share. Okay, here we go. I thought this is interesting. Microsoft is larger than the 23 stocks, and these are stocks, energy stocks in the S&P. So it's not like, XYZ drilling, on the AMEX. These are 23 stocks in the energy sector in the S&P 500, don't add up to Microsoft. So what does that tell you on the surface? Like, there's a couple of things. Well, it tells you how great Microsoft's been, right? It's a great company, done amazing things, but it's taken a long time and a lot of energy to get this point. But also it says that the other area is way underinvested in it. So that's what I think. I think that the Microsofts, the Googles, the Nvidias, the Teslas, the Apples of the world are avoids. Avoid just means our market performers. Like if I was a Wall Street analyst, I'd probably rate them market performers. If the market goes up 10%, they'll probably go up 9 or 11, maybe a little bit more if you're lucky. If the market goes down 10%, they're probably going to go down 9 or 11. It's just going to kind of be I just don't see how they can have like any huge outperformance. But I could be wrong, but that's my thesis. And that's how I've thought for a long time here in the last kind of 16 months. And I just trade that accordingly until I'm, convinced that I'm wrong. But so far, I think that's been the case. You'll see when I pull up the charts. So, but this area interests me. I'm always looking for areas. The energy has been pretty weak lately this year. You have to pick your spots, but the underinvestment there is not encouraging is that right word, but intriguing is the word I was looking for. All right, industry groups and then stocks to watch. And then in stocks to watch, I'll talk about shorting because I think I said I wanted to do that. Resume share. Okay, here we go. Weekly review, industry groups. Leisure movies related. What's that? Netflix, commercial services, leasing, oil and gas field services, lost number 1. That's Weatherford, TDW. Now, Weatherford's been just a beast. And I actually do own Weatherford. Holding up really well. Well, it's not. I take that back. It's not in. It's in machinery equipment. But TDW, nothing wrong with that one. Halliburton, just okay. Schlumberger, they're just a little big. You can see why TDW has done better, just from a sheer size standpoint. Look at the market cap on that. It's very little. Acting really well. Retail office supply, leisure gaming, the reopening of China has helped that area with wind, et cetera. Building, home builders, the narrative is, mortgage rates have, twofold, threefold off the bottom. Therefore, housing has to go down. And what happened? Housing went up. So sometimes it might already be built into the price, which is fun. Interesting. I hear that a lot from people. It's like, why did XYZ go down? The earnings were so good. Well, they weren't as good as people wanted them to be. They knew they were going to be good. Why did Nvidia go up? The earnings were terrible. The cash flow was terrible. The EBITDA was terrible. Well, market knew it was going to be terrible. It wasn't as terrible as they expected, or what they said on the conference call was more upbeat than people expected, right? So it's all about the delta, the change. Markets can go up on less bad news, and they can go down on less good news. You got to try not to. You don't want to understand the stock market. If you want to understand the stock market, you're going to have a hard time making money, I think, in my personal opinion. So the industry group's very diverse. There's a lot of areas you could be in. I think it's fine. I don't see any kind of signal by the industry groups sometimes there's signals like in that 2017 period where software is just, eating everybody's lunch. So you want to be exposed there, but this is very diverse. I don't see a whole lot there. All right, so let's talk about stocks to watch. I'm going to turn off my camera. Hopefully that will give you guys a better chart view. And, so I want to talk about shorting because I know a lot of people think about it or curious about it or want to get involved. So my first thought is if you're a doctor, lawyer, an engineer, school teacher, forget it. Don't worry about shorting. The big money's made on the long side. So you want to learn how to sell. You want to learn how to protect yourself. You want to learn how to ebb and flow and navigate. And when the market's good, be heavier. When it's bad, be lighter. But I wouldn't be all that interested in shorting. That's my first thought. I have made really significant money in 2000 and in 2008 on the short side. So admittedly, I have kind of a soft spot for the short side. Now, there have been other periods where I've lost a lot of money shorting. And I know that I didn't do all that well in 2009 because I was thinking I was in that short sale mindset. So there's pros and cons to everything. There's a yin and a yang to everything. So, but I like having something short to reduce the volatility of my longs. The big money is going to be made in being long. I think Jim Chanos, he's run a short fund forever, and amazing track record, and has picked some really good shorts, Enron, AOL, stuff like that. Don't quote me on this, but I thought I read that his overall return is flat. Like you haven't made any money from being with him. Now, the S&P and the NASDAQ and the Dow have gone up, 20-fold in that time period or whatever the number is. So flat is amazing. And my understanding, I think, is he's long the indexes, like he's long QQQ or SPY or whatever, and short individual stocks. He's trying to grab that alpha to the downside. But if you're an institution, say you have $100 million book and you give 10 million to Jim Chanos, you have 90 million long, and your long goes down 20% 1 year. So you lose 18 million on your long portfolio. But he goes up 50% that year. So you make 5 million on that 10 you have with him. Well, you take the 5 out, you redeploy it into your longs, and now you're back at 10. The next year he's flat, you make 5%. The next year he's flat, you make 6%, and so on and so forth. So you could see how it would be appealing to institutions in that regard, kind of like a hedge. And that's kind of like how I think about the short side most of the time. If it were in a massive bear market, that would be different. But like right now, they're really just kind of a hedge on the market volatility. So like this morning, when the market opens lower, I have AMZD, which is Amazon down. And I have TSLQ, which is the Tesla down, and both of them open higher. My longs were opening down mostly, although some of them actually opened up, like TRMD opened up really good. But on the open, I wasn't hardly down because I had the kind of offset of these. Now that's a perfect scenario. Doesn't always work that way, but that's kind of the idea. So I take off the shorts. I got out of the Amazon long, not because I like Amazon. I just wanted to reduce it. And I still have the Tesla short one, but now I've got a little bit of, I've reduced some exposure. Let's say I made 0.5% in Amazon down in my account. XYZ is down 0.5%. Those offset each other, and you get the idea. So that's kind of how I think about using the short side. Sometimes I'm just flat out think the market's going down a ton and I want to be short I treat it that way as speculation. but other times I treat it like, kind of a hedge on if the market's not great, it's not bad, it's not great. Got a lot of these long exposure. I like to have something on the other side. So that's kind of my 2 cents on shorting. So Microsoft, it just to me looks like a pair of twos, right? I don't think it's going anywhere. I think this will be the top for Microsoft for a long, long time. Again, am I going to be right? Who knows? But something like this. And if I'm wrong, it doesn't matter. I don't lose anything. I'm not going to short Microsoft. It's just an avoid. Just don't want to be playing in that sandbox. Apple, same thing. Just a long sideways action. Amazon, worse. This was long sideways action. Now it's actually probably going to live under here a little bit more. Google. And these are great companies, right? I always hear how great these companies are, and that's true. They provide great, but investing, you don't invest through the rear view mirror. A lot of people invest through their rear view mirror, or there's a saying it's generals fight the last battle. So I'm not really a World War II history buff, but I love history. I think history is great. So the French built the Maginot Line because that was how World War I was fought, and then World War II was different, and the Germans just went around that. So I'm not going to go down this road here, but you get the idea. It's kind of a rear view mirror. What worked before, the markets change. So Google, Apple, although I've probably thought the same thing for Apple many years ago and was wrong, the market seems to have changed for these. And these will probably just be market performers. If I was a Wall Street analyst, I would call them, market perform. The market goes up 10%, they probably go up 8 to 12. The market goes down 10, they're probably going to go down 8 to 12. I just don't see them really outperforming the market like they used to. So you have to find what's new. What's new. Now, my thesis is it could be in energy and infrastructure and things like that, but I'm not going to guess. I want the market to show me that that's the case. So I need stocks with earnings and sales and relative strength. So here's a stock that I was buying here, and this quarter didn't exist at that time, but this did. Oops. Earnings were up 200%, revenue up 140. Earnings up 162, revenue 96. Earnings were negative, revenue was barely. What do you see there? Accelerating earnings and sales, right? Things are getting better. I don't have to have, 5 years of earnings growth, but I really want to have at least 1 or 2 quarters. And I want a stock that has relative strength that's shown me it can go up. The TNK went from 22 to 36 before it built a whole new base. So that's, there's stuff out there like this. Sting, here's 400, 400, 600. Look at the revenue. Negative, 7, 30, right? Starting to turn around in March 2022. Right there. Now, if you're looking for a pattern, that was pretty hard to buy. This is kind of a tough stock to buy, but you could have bought off the moving average there, and now you have the first base that's coming out of. So if you only need to own 10 stocks, I found 4 or 5 of them in just this group alone that I felt you could own. TK, smaller, more speculative, but same thing, earnings and sales. So in the long run, stocks kind of follow their earnings. And if it's up to me, someday we'll have an earnings line in Marcus Smith. I think it would be a great ad for sure. But if you look at McDonald's, there's a famous chart on the internet. I think Walter Deemer posted it if you want to look for it, where the earnings line for McDonald's is straight up and the stock was straight up. And then you got into a really bad market, so the stock had a hard time going up. I'm gonna go all the way to 82 here, but the earnings kept going. But the stock went down. It got compressed because the PE got ahead of itself. But the earnings kept going, and ultimately, what happened, right? If I go to like 88 or something, boom, McDonald's breaks out and keeps going up. It almost had to, because the earnings line was doing this. So, but this is a monthly chart. It's a long chart. You have to look at that chart. It took a long time for that to happen. But in the end, stocks are going to follow earnings. So stocks like, DoorDash, which is a stock I am short DoorDash. And they can't make money. They can't make money. Why would you ever want to be in something like that? At least just give me 1 quarter. 1 quarter. And Jim Chanos says, he has a great saying, I love it. If not now, when? So I think about that for the companies. I mean, if they can't make money in this sweet spot for what they do, when are they ever going to make money? So DoorDash is a great example. It's a perfect example. It totally explains. You have the pandemic. People are ordering because they can't go out. Restaurants are closed, and your stock tried to go up, but it can't make money. It can't make money. So if they can't make money in the perfect sweet spot, when? And the answer was probably never, at least so far. And it's turned out to be a great short like that. And probably, I mean, I'm still short the stock. Now, don't get me wrong. I tend to hit and run on these stocks. So I'm not short from 180 down to 55, but I might grab, 10 or 12 points here and there if I get it right, lose 3 or 4 if I get it wrong. You get the idea. On the short side, the only time I ever kind of had a little bit of conviction with Tesla for whatever reason and stayed the course with that TSLQ last year for this move. But mostly on the short side, I tend to hit and run. If I get some kind of semi-meaningful profits, I will take them off. You're not going to get rich on the short side. It's not you want to just stay in place, stay engaged. If you're doing this, the big money is going to be made on going long, obviously. Okay, so these are stock. I do own Sting, TRMD. So they're out there. Do your work. Relative strength, relative strength, relative strength. It's just the best indicator. You don't need anything else. Just show me all the stocks that don't want to go down. That's really the best way to find winners. AEHR. Let's go outside this group. Let's go back. I don't know, Scott. I can't buy it. It's too high. It's 29. I should have bought it at 18. Relative strength new high. Yeah, in hindsight, you should have bought it at 18, but at 29, on its way to 31, on its way to 35, on its way to 36. You get the idea. ACLS. Let's go back to 2022, I think. Blue dot, RS line new high. Let's go to the index. I don't know, Scott. I can't buy this. We're in a multi-year bull market, a bear market. It's the greatest bubble ever. Jeremy Grantham says so. Blah blah blah. Okay, no problem. Maybe if you're short, what could it hurt you to have one long? That's kind of how I thought of it. Now that one didn't work. The market got so bad it didn't matter. Okay, fair enough. I stopped myself out. Oh, guess what? This looks like a double bottom to me. And I bought this stock in the mid 60s. Now, it'll go to the quote of the week and stay with it long enough. I didn't handle it very well, but it was there for me. I had a chance, right? I had a chance versus just ignoring it completely. So this stock was screaming at you that it was a leader. And I apologize. I take that back. It was this double bottom, not that one. But even if you bought that one and gave back your gains, got to try it again. This one has worked. Stocks up 54% from the pivot. Remember, I paid 65 or something like that. So it's more than doubled from that buy point. And has it given, I mean, you know, I think about like Kathy Donnelly or Eve Bobeck or people I know that more patient than me. And I don't know if they traded ACLS or not, but like I look at where was the sell signal? What did it do wrong? Never even closed below the 10-week line. So there's no reason to think that it would have been impossible to hold it for that type of move. So relative strength, that's the lesson. And being patient is the lesson, which I'm always harping on for myself. So I hope this video wasn't too long, but anyways, we're going to go back to the video and let's go to the quote of the week. Nick Sleep, Nomad Investment Partners. I think Nomad is closed now, although maybe it still exists as its own family office. But they had a great track record, and they were very patient and very concentrated, which is very hard to do because when you're concentrated, it's hard to watch. But he, you know, he famously had a big position in Amazon for a long, long time, and his investment letters are out there on the internet in PDF, so you can read them if you're interested in it. And I liked, you know, to read stuff like that. It might not be perfectly fit to my style, but I like the thought process. I think the thought process is what's most important. Any superiority in investment process may have only emerge with time, so patience is important. It takes time. Bill O'Neill will say it takes time for a stock to make a big move. And my experience, a lot of times, like I'll identify the stock early, like ACLS. Well, I identified it early. I knew that stock was a leader. It just kept telling me, I don't want to go down. The market's bad, but I don't want to go down. But that didn't do me any good if I wasn't there for when it really runs. And the sweet spot is near the end, is I don't say the end, but after the breakout. They just don't break out and go up 45% in a week and a half. A lot of times they'll break out, sit there for a week or two. Maybe the market's bad. That's what allows them to build a base and create the breakout. There's some kind of thing going on in the market that otherwise stock would just keep running. So, you know, you want these markets to pull back every once in a while. So you have to be patient, allow the stocks to, you know, let them show you where they want to go. Is a saying I like to see. Let that stock show you where it wants to go. So a lot of you might be more patient than me already. And you might have the opposite problem. I think a lot of people would tell me stories like I was in XYZ, it doubled, I gave it all back. So this wouldn't apply to you, but then you want to develop a strategy for not allowing that to happen. Maybe I think the best way to handle this is to take a few bites of the apple, so to speak. Don't eat the whole thing. So if you have a really good stock, it's acting well, you have 1,000 shares, take off 100, take off 200. You know, 2 weeks later, maybe take off another 100. 5 weeks later, maybe take off another 100. And it's no fun if it keeps going up and up and up, but you still have 600 shares. That's how I have been doing it for a while, and I think that's the most replicatable strategy out there for holding on to these big winners. And you know, it's always in hindsight. I'd love to have my original big 20% position in ACLS up 100%. That would be awesome. I can't do that. So why not have 5% position up 100% and the other 15% where I netted, let's say 20% or something like that. That's the strategy. I think it's possible. You could do that. You can definitely do that. All right. I appreciate patience. Hopefully this video wasn't too long. I'm curious how long it was, probably about 40 minutes. Marcus Smith at investors.com, 800-424-9033. Have a great weekend, everybody. Next week, I think, is the Stay in Step. So there won't be a Take on the Market video on next Friday. Bye, everyone.